Hi, this is Ant Lyons from Your Property Network, and I'm on this call with a really good friend of mine and no stranger to the pages of YPN, Kevin Whelan. So, Kevin, thank you for joining me today. You are our go-to expert on all things pensions and property, and this is what we're going to be talking about today, a topic that we've covered before in the past, but a really, really important one for people to be able to tap into funds that perhaps they weren't aware of. A lot of misunderstanding around this topic, I'm sure. And so you're here today. People might be watching this on YouTube or listening to it on the podcast or reading it in the magazine or watching it on the app to pick your brains on what can we do with our pension in terms of investing in property. So could you just tell our listeners, our readers, our viewers a little bit about yourself and what you do?
Sure. Well, isn't it fascinating how it's so multimedia these days? And I think there's a challenge with so much information that it is very easy to become deluged with information. That confusion can often get in the way. So, and when people get confused, they often get stuck and don't know what to do. They don't know who to trust. They don't know what's right. And pensions are a real challenging subject. And I've been around pensions industry for 30 years now, and now you're supposed to say, in
your teens
well, anyway, a long time. And what I discovered over my years traditionally as a independent financial advisor is pensions have been put in place as almost the mainstay of how people build their wealth in the UK. They rely on pensions more than anything else, whether it's the state pension, which is increasingly going back and back, whether it's defined benefit pensions, the pensions from the big companies and the banks, and now only the privileged few of the public sector have them, or private pensions and workplace pensions, which are just money in a pot that goes up and goes down. And my challenge is those stalwart things, the mainstay of stability, because retirement is about safety, security, stability in a world which is fundamentally uncertain. And I think the pensions industry has really failed to deliver something that is safe and sustainable. And the evidence is so much the case now. The state pension pushed back and back. The foundation of the final salary pension eroded now, only to public sector. And personal pensions, people don't have a love affair with their pension. They don't have any feeling of connection or control. And in 2008, I discovered that despite my best intentions, an honorable person with the intention to try to help people do the best they can saw the credit crunch come and the stock market crash, and innocent people who had been almost indoctrinated in the line, set and forget your pension, the long term will take care of itself and you'll be okay. You're not okay, because what happens is stock markets rise and fall very quickly, more than ever before. And in 2008, when I saw 30%, 40% in some cases of innocent, ordinary people lose money and nobody could do anything about it, it just made me think about, is that the best way people can build a retirement income? Now, putting aside, there've always been entrepreneurs who build businesses and always been property entrepreneurs who build property. But often when people arrive at this decision that maybe they want to build their wealth, they will do so often excluding the pension. They almost see the pension as, oh, I've always had that, do not disturb till 65. So I'll leave that money over here and I'll build my wealth over here. And I just thought, well, that's money, isn't it? And it's real money, and it's real money that can be used. So what I've really discovered since 2008, really, when I got into this, is what is the best way for people who are willing to take control, willing to become more responsible for their financial life and be willing to make decisions, surround themselves with good people, get good education, and take that responsibility. And that's when I founded Wealth Builders with an alternative view. So instead of becoming or staying, if you like, in the closed fit, tight grip of the only thing you could do is regulated pensions, I just widened that and created Wealth Builders, which talks about how to build wealth with multiple streams of recurring income flowing from many directions, which can include the pension. But then in 2009, I just discovered something that kind of shocked me, really, which was I was looking to do a commercial to residential conversion with as a joint venture with someone. And because I was well known in the SIPP industry, self-invested personal pension, often actually confused with the word SAS, which is the small self-administered scheme. The language of both of these things is awkward, and therefore, because it's grey and dreary, people don't really penetrate the veneer of that. They don't see behind it. But anyway, I had a SIPP at the time, and my SIPP provider said to me, Kevin, we know you know your stuff. We'll be more than happy if you use your SIPP to joint venture with your business partner in this project to do a commercial to residential conversion. Happy days, says Kevin. That's great. I can take responsibility for my pension. I can remove the reliance on the stock market. I can put some of my money that's in my pension into property in the way that I wanted to. And at the last minute, they changed their mind. The last minute, they said, we changed our mind. I said, what do you mean you changed your mind? You told me, and I made a decision based on what you told me. Yeah, but we've changed our mind. And there was no amount of puffing, or persuasion that I could make them change that. Now, that meant the project couldn't go ahead in the way that I planned, which is disappointing, and made me realize actually quite, I would say, I kept the lid on my emotion, but I was completely seething about that. And as someone who's always been a keen advocate of being in control, I sort of had that stark realization you're not really in control of your pension at all, because a pension is a trust fund and somebody has to be the trustee. And in a SIPP, the trustee is the person who's running the company who provides the administration. And in a big company, it's that company. And if it's a big insurance company, it's the insurance company. And then you realize that actually the only way a trust fund can reflect who you want to be, instead of reflecting their business, your trust fund reflects your business to take control. And the only pension that allows you to take complete control is known as a SAS. And I didn't know about SAS, genuinely, and humbled by it, thinking, well, I'm a smart IFA, should know this, but I didn't know about SAS. I knew it was there, but really, truly did not understand the huge benefits that I've now come to realize, that I now share enthusiastically wherever I can. Not that I'm saying a SAS is for everyone, because control is not for everyone. There's rigor, there's due diligence, there's a whole raft of things that need to be done. However, for those who are willing to do that, then the SAS is probably the most powerful vehicle I've seen that combines old money with a new plan, that turns pensions into property. And that's why I became an expert in SAS and have created training materials, which are now CPD. So, we teach accountants this, we teach lawyers this, and we definitely have taught thousands of property people how to turn their pension into a trust fund that they can control. And we can get into details of how they can do that and how many people could be involved and what the things you can do and what the things you can't do, all of those things. But that was a short question you asked, and I gave a very long answer. But you can tell I'm very passionate about it, Ant.
I definitely can. And in the instance that you had, your situation, I guess, could have been a lot worse if you'd been kind of banking on those funds sort of further into the deal. So, you could be, whatever the amount is, you could suddenly be that much shortfall in the middle of a project and having to find that. So if you find this out beforehand, it's annoying and frustrating and disappointing, and you want to rant and rave, but at least you haven't got into the deal and then come up short with the funds, I guess. And I would imagine where you paint this picture of these kind of big organizations who are the trustees of your of your pension, your money, I guess they don't understand your deal. They don't understand your ability to deliver the project. I imagine that they just see that as, oh, well, that might be risky, and so we'll say no. Is that what happens?
I suppose the whole pension industry is regulated, and that regulation currently stems from a piece of language which may not be familiar with many, called consumer duty. Now, consumer duty is very laudable, and it's about trying to have advisors take some degree of involvement and responsibility in the outcomes of the people they serve. Now, lay people who are doing day jobs, running a business, don't want to take any involvement in their wealth, quite happy to park their money in the stock market if that's what they want to do, then that responsibility on the advisor is to try and help them understand, well, what their life is going to be like when they reach retirement, and what risks they've got and what risks they're taking now and what other income is going to come in. So in other words, there's a huge degree of involvement to understand exactly what someone's outcome is. Now, when you look at entrepreneurs, business entrepreneurs and property entrepreneurs, they don't know what that outcome is. So you couldn't have an advisor take responsibility. It'd be like me coming to you with a wonderful business of YPN and all of its outreach now and saying, I need to take responsibility for how that business is going to work for you to have this pension. That's not right. So the SAS removes that. So it's not regulated. A SAS is a small self-administered scheme, which is a unique piece of landscape in the pensions world. It's been around since 1973. It's not new. It's been around for ages. But if you think about how pensions are marketed and how pensions are provided in the UK, they're either provided by employers, they're big schemes looking after thousands of people, or by insurance companies, big schemes with thousands of people. But in the 70s, they created this little piece of landscape, little sliver of land for the number of people who wanted to own and control their pension so they could be the trustee. And that's what small self-administered scheme means. Small means not big. So less than 12, that's the legal definition of small. So if you look around and see people building businesses and building property portfolios, it tends to be husband and wife, 2 or 3 business partners, siblings working together, family, up generation, mid generation, even down generation, 6, 7, 8 people. Perfect landscape for that to work now for the small business owner who wants to be in control. Now, the self-administered part of that language doesn't mean administration, it means direction. So self-direction means if you consider yourself as a director of a business, you've got responsibilities, you've got outcomes that you're judging for yourself, you've got business plans, marketing plans, a whole raft of things where you're trying to build and achieve an outcome for yourself. And so it is with SAS. So a SAS is just a business with a pension wrapper. So if you can take responsibility for a business, you can take the direction responsibility for your SAS. And scheme is just another word for pension. That's a legal definition. So a small scheme, small pension for up to 11 people that you direct yourself. That's really what it is. And the probably, in the number of years since the 1970s, since it came in, probably only 30, 40,000 business owners did that. So a tiny, tiny, tiny carbuncle on the elephant's rear end of an industry, tiny. But now the proliferation of limited companies set up by property people since the intervention the government made in whatever it was, 2017, Section 24, and all the things that you'll have written about and experts will have talked about, that tax treatment that we can talk about whether it's fair or unfair, it's there. So as it's there, we've seen many more property people in recent years create limited companies. So whereas historically, they would not have been eligible for SAS because they didn't have a limited company, they had assets in their personal name, they've now become eligible. And that eligibility has been an increasingly large marketplace of people waking up to the fact that if I want to take the pension that I built in my past and make it a part of my current life, not wait till I'm in my 60s, how do I do that? And I've created all the knowledge, the support, the coaching, the community that helps people discover that, and then helps people to be both compliant, so they do what's right, but compelling for their own future. And as we'll discover if we talk about it, for the next generation as well, because it's a really, really powerful tool for inheritance tax mitigation and for preparing a legacy for the next generation. So it'll be hard for you to pin me down, and there's so many different areas where I'm a fan of what SaaS can do.
Okay, so let's try and paint a picture of people that would work with you and may listen to this, watch this, read this, and say, well, that's me. Okay, I put myself in the bracket of someone who likes to take control, doesn't necessarily want to bank on the stock market performing, something that is out of probably anybody's control. Who are those people, and at what point do they come to you? Do they have a SaaS already, or do they have a different form of pension that can be changed into a SaaS? Or how do you see people when they come in?
Yeah, so invariably, SaaS is not something people get on their own. I don't meet many property people at all who've got one. A handful a year. What I meet is people who've invariably run out of money before they run out of ambition.
Yep.
They need more money because the creativity of finding deals is not yet matched by the creativity of finding money. So when they run out of deposits, when they run out of finance, yes, there are great brokers, and yes, there are great institutional providers of funding, but the opportunity to take the money that's been accumulated normally. So the first group of people are those who maybe have come from a corporate background. They've built up some pensions in their years. They may even be in a job, and they're trying to transition into being wealthy as opposed to trading time for money. They're looking to build recurring income, and property being the most obvious asset that people turn to, and for reasons we well understand. So they come and they say, hey, I've got a limited company and I've got this amount of money. How do I combine them to then allow that money to help me on my property journey and keep that money flowing? So I'm providing the money to myself, not having to borrow the money from a third party, which then reduces the debt costs that they have in their life, as well as giving them more money to get exposure to find and fund more deals. So it tends to be not people at the beginning of their journey. They've already done something. They've done 2 or 3 deals possibly already. They know what they're about, and then they've realized, yeah, I need more money. And that's when they'll find their way to us, whether it's because they hear me speak, where they hear a podcast that we've done, they listen to something or hear something from you. And we're connected with so many of the really, really good property educators who realize that this is a good skill for their property students to have. So as many different ways as we find to connect with people, then we take them on a journey to discover whether SaaS would be a good fit, at least to explore whether or not it could work for them. And there are some eligibility criteria that are set by HMRC, who approve each and every scheme, and also from our perspective to understand, are you really ready? Is this a good time for you? Do you have enough money? Just try and assess that as well. So we take some responsibility, but it's not regulated advice in the sense that we're taking responsibility for their decisions. It's to help them understand whether they'd be eligible and to understand what they can do, because there are some things, as we all know, pensions can do, some things pensions cannot do, because no matter how thinly you slice anything, there's always 2 sides of the risk, there's always 2 sides of the story. So you have to understand that, and that's what we try and do.
Okay, brilliant. And we're going to talk about what people can and definitely can't do in just a few moments. So people would come to you, would they have money in a pension in a different format already at the moment, or money that's within a limited company, or could be a combination? Or
yeah, that's a great point. So the fuel for SaaS. SaaS is a vehicle, and it's a complex vehicle which needs some instruction, but it needs fuel. Where does that fuel come from? Well, primarily it comes from historical pensions that have been accumulated that are still on the stock market. And as long as there's enough money, and we can talk about the specifics because that will be about timing, but let's say in approximate terms, anything 100,000 or north is really worth a solid conversation, just because there are some costs and establishment and things like that. But the other value to understand is historically, when people have got their pension, it's theirs and theirs alone. But as I mentioned, SaaS is a collaborative vehicle which can have up to 11 people in it. So if you've got 100,000 and your spouse has got 100,000, you've now got 200,000. So you can combine that money. If you've got business partners, you've got even more. So the fact that you can combine and collaborate brings more money to the business to allow them to invest in property. So it's a collaborative thing. Now, sometimes it's old money, previous pensions, workplace pensions, private pensions, but sometimes we meet business owners who perhaps really never fancied pensions in the first place. They just thought, nah, my pension, don't want to do that. My business is my pension. And they've accumulated cash in their business. But then they discover SaaS can help their business or help our new business, which would be a business of building property. Then they can use that profit that they've accumulated in the business on which they paid corporation tax, and they can make that as a contribution and then get the tax back. So they get the corporation tax back they paid. They've now put that money into their trust fund, their SaaS, their own scheme, and now they can use that money for purposes that we'll get onto. So for many reasons, business owners who don't want to draw the money out of their business for fear of paying the dividend tax and so forth, they will see, wow, I hate paying corporation tax. Okay, how can I get the corporation tax back and then use that money so I can benefit from it today, not wait till I'm in my 60s to benefit from it. We've seen growth in that as well.
So I was going to say, in this instance, then people are not only saving on the kind of dividend tax or income tax that they would pay, north of 40% in terms of removing that money from a business. They'd also make a saving on the corporation tax side of things, which, corporation tax is currently 25%. So there's a really significant saving to be made, rather than just saying, well, here's profits in the business, I'll pay that out to myself, and now I'll do something with it, because that's a really expensive way of using that money.
It's hugely expensive way to use the money. And if you paid it in salary, for example, you'd also have to pay employers' national insurance, which you just don't have to pay. And you can make contributions of up to £60,000 per person per annum. And in some circumstances, you can actually go back to previous years and mop up allowances for previous years you could have done but didn't do. And in very exceptional cases, if you've got a super successful business, you can pay up to £500,000 in 1 year and get the tax back, which would be, in that case, best part of 100,000, in the same year. So some incredible tax benefits, way beyond just the simplistic nature of the money growing tax-free. Inside the pension, there's no income tax, no corporation tax, no capital gains tax, and there's no inheritance tax. In a SaaS is entirely tax-free. So it allows people to grow a fund which is ring-fenced and protected, by the way. So creditors can't touch it, no lawyers can touch it. So it builds an incredible security blanket for business owners and for property owners. It gives them an additional source. If they're making good profit, they can shelter some of that profit. If they're not yet making profit yet, they're still on the journey, then they can use that money to help them fuel that journey for in ways I'll explain in a moment.
And in terms of the other people, so these are people who might be holding cash in businesses. The people who come to you who've got a pension at the moment and say, and they listen to this and they want to take control. They've got money in a pension at the moment, but they want to transfer that into a SaaS to have more control. It's not everybody, is it? Not everybody can come to you, Kevin, and say, I've been working as a nurse for the last 20 years. I've got a pension. what can I do with it? It's a bit more bespoke than that, where you're looking for particular types of people to help.
Well, it's not the people, it's more the source of pensions. So, and it's a good point you make about public sector. So if you're in NHS, fire brigade, armed forces, teaching, where the public sector is providing the pension, they're really providing a future benefit. So the benefit is all wrapped up at a retirement age benefit. So there is no possibility of that money, which people think there's a pot there, but there really isn't. There's no money there. There's no money in a pot that says this is your money. It's a future benefit to be paid by future taxpayers. So there isn't a pot to have. And this disappoints many people. Now, it's not really necessarily a source of disappointment, because if you can get a guaranteed pension, which is fixed, it's protected against inflation, and hopefully the government doesn't go bust like some councils do, then at least you've got a foundation on which you can build your wealth. But you won't get it till retirement date, and you can't use it now.
Okay, so instead we're looking at people with a SIPP, a pension that's been set up a while ago. Would that be correct?
Yes. Again, many people thought control was done in SIPP, self-invested personal pension. It sounds like it should be with the language, self-invested, but the investment is almost always, you can choose your own stocks, you can choose your own funds, you can choose ETFs, exchange traded funds. There's many things you can do in the marketplace, but and in some cases you can buy commercial property. But as we'll discover as we see the richness and the tapestry of different ideas people want to use and the strategies they use to build their wealth, commercial property is not the only strategy that people want to use. And what they then discover is SaaS can help fuel many property strategies, not simply the commercial one. But SIPs can do a perfectly fine job. It's just looking at the differences between SIP and SaaS and how they work. A SIP usually is one person. SaaS is that collaboration. SIP is somebody else's saying what you can invest in. SaaS, you've got much more control. Both of them will get the tax relief. Both of them will grow tax-free. It's really a difference in the strategy and the number of people who can collaborate together.
Okay, so let's say we've made the decision where we're either putting money into a SaaS from money in a business at the moment, or we're transferring our SIP into a SaaS. Can we talk about what the limitations are and what we can do with that money held in our SaaS? Because I think this is the area that probably there's very little knowledge on. I think a lot of people just wouldn't know what can I do and what can't I do. So could you talk us through that?
Yeah. Well, investments are as wide as people are, so traditional investments, such as investing in the stock market, is perfectly fine. ETFs, exchange traded funds, other alternative investments in markets would be gold bullion. You can hold even cryptocurrency. There's just a wider range of investments you can hold. If they're traditional crowdfunding, if you want to invest in other people's projects. So a range of different things that are possible there. But when it comes to the direct ownership of property, the tangible asset that people fall in love with, then commercial property, very simple. Again, combining money means often there's more money available to do that. That money can also be leveraged. So if you've got, let's imagine 4 people have put 100,000 together for the sake of a number, they can also borrow 200,000 from a bank, which means they've got 600,000 pounds worth of buying power. On their own, they wouldn't have had 400,000 because each one had an individual pot, and their trustee, their previous pension, wouldn't have allowed them to invest in commercial property anyway. So commercial property, really simple. More complex ones where it gets a bit grey, so I don't want to be definitive, would be commercial to residential. That can be done in certain circumstances. You can purchase land, and then you can build on that land. You can purchase almost, let's say, commercial units with uppers. You can purchase things which you can convert. So you can convert a barn, you can convert a pub, you can convert an old police station. An old railway station we've even seen being converted. So many scopes for conversion and adding value. You can collaborate with others, so you can joint venture with other people's projects if you want to. I mean, the list goes on and on in terms of what you can invest in using the pension itself. And if you have any other questions about what the pension can hold, I'll cover that, because one of the big benefits to highlight is the fact that uniquely with SSAS, so not with a SIPP at all, under any circumstances, you can lend up to 50% of the value of the SSAS back to the company that set the scheme up. And that's where more often than not, we see our SSAS owners want to use that money, that 50%, because then they can lend that money to their property company. And if that property company acquires residential property, they can use that money to acquire still further residential property. And that's when the imagination really starts to take off.
Okay, so in that instance, let's say it's me, would I be owning the residential property in my name or in a company? How would that work?
How that would work is, if you want to own, let's describe what I mean by, just, you forgive me, I'm just getting my power sorted out. Rookie mistake, should have powered up. Now powered up. The facility called the loan back needs really quite a full description to make sure it's well understood. So first of all, the government allows, HMRC allows, a loan of up to 50% of the value of the total SSAS, so people combining, to be loaned to the company that set the scheme up, otherwise known as the sponsoring employer. That's the technical definition. Now, if the loan is made to the company, the SSAS itself is technically made an investment called a loan note. So it's made a loan to the company. So that's like a bank making a loan. Now, the loan note needs to be reflected in a document. And that document has got to include a number of elements. Element number one, the loan needs to be made to the company. It's not made to a person. It's not made to an individual. It's to the company. Number two, the loan needs to be secured by way of a first charge on at least the value of the loan being made plus the interest payments. Right? So that often leads to a debate about what can be used as security. Number three, the interest rate needs to be repaid or needs to be set by agreement, but can be no less than 1% over base rate. So there's a formula for this. And then the loan needs to be repaid in 5 years with an equal installment of capital and interest over that period. Okay, so there's something to unwrap in there. Okay, so let's take off 400,000. We can lend 200,000 to the company. Approximately, it's not exactly 200,000 for the people who are reading between the lines of the interest payment. The interest, say the interest rate was 5%, 1% over base would be 6%. You've got to pay 6% back to your SSAS. So what the SSAS is earning is an interest-free loan, an interest payment, which goes back to itself. So it's growing. And then the capital needs to be repaid within 5 years. But very often what people do is lend money for a year to their company. They do a flip, and then they pay the money back, and then they're recycling their money. So there are some challenges for longer term holds if there's not enough cash flow to repay both the capital and the interest.
And I guess in a sort of refinance project where we might be looking to get all or certainly the vast majority of the money back out on the refinance side of things, then the SSAS would lend the money to, let's say, Ant Lyons Limited or Ant's Properties Limited. That company purchases the property. It can add value, refinance with a term lender, and then pay back the capital sum and the interest to the SSAS. Is that correct?
Correct. And it can the money is paid back to the SSAS, but the capital value of the asset is owned by the company, and the income stream that flows to the company. So in other words, it's a way of creating an income stream today, whether Ant's company is owned by somebody in his 40s as opposed to somebody in his 60s or in their 30s or in their 50s, doesn't matter. So it allows an income stream to be gained today from an asset that they thought was not going to be available to them until they were much, much older.
Okay.
So that's real value in the loan back.
And so in this instance, Ant Properties Limited, are there restrictions on the type of property that I can buy there? Does that property that Ant's buying, does that need to be a commercial property, or can that be a residential property?
No, it can be a residential property if it's in keeping with what the business does. So there's no restriction that says it has to be commercial. If you're buying with the
to sit in the SaaS, yeah.
Sit in the SaaS, yeah, that's a good description. If it's to sit in there, it needs to be commercial. If it sits outside and the money's loaned to the company to do it, doesn't matter what type of property it is, as long as it fits the loan criteria that I've just given you.
Okay, amazing. And I guess you're probably getting busier and busier these days because so many more people are holding residential property within a limited company. We're all aware of what's happened with Section 24 and the tax implications of holding property in our personal names. Have you seen a big uptrend now from people who are, this is almost the kind of, in a great way, the kind of perfect storm to enable this to happen because so many more people and lenders have come forward to lend into limited companies?
Yeah, we're definitely seeing that. We're seeing a pickup. Again, it needs to be explained because there is complexity here, as you can see, but that complexity is not that difficult to unpack if you spend some time and learn how it works, how it might work for you, not just now, but how it would work for you in the long term as well, because a pension is still a retirement vehicle. I mean, let's not lose sight that it's a SaaS is really an occupational pension scheme set up by the company's owners for the company's directors in the main, and it still needs to deliver that. So what we're not looking to do is say all of the value needs to sit outside. That's why there's that limit to 50%. But it's the value of either holding assets that you want to hold with the flexibility of those different things I've mentioned before, whether it's property or other assets, but you're still allowing yourself to grow those completely tax-free. And you can invite children to participate in that when they reach the age of 18 as well, which gives you even greater scope to be able to not just make contributions, for example, if they're part of the business, or, you know, if we dare get too complex on the subject of something called the lifetime allowance, which is where previous governments have put a limit on how much they think you should have in your pension to be completely tax-free. Why a government should have a role to say in that, I'm not quite sure. But we've seen that allowance pegged at around £1 million historically. Now, it's gone at the moment, it doesn't exist right now. But we have heard that Labour may well at some point bring it back. And the real value then of having multiple people inside a SaaS is you've got multiple contributions you can make and multiple allowances that is possible to take part in. So there's just so many tax breaks and benefits beyond the scope of, let's say, you know, an hour's call together that people need to consider and understand how it fits their overall family's wealth plan and their intention not just to pass on a legacy, but to impart wisdom to the next generation as well and get them to participate in a way that they never dreamed they would. I mean, as an 18-year-old, were you ever participating in a SaaS? You know, were you ever investigating opportunities that the family were doing? Probably not. So this is a real enlightenment tool for the next generation as well, because in certain circumstances, you know, they will be able to inherit the entire pension and never even pay income tax on it. Now, that would be rare, but nonetheless, having that money entirely inheritance tax-free and it's ring-fenced and protected for a lifetime means that they can continue that trust on and enlighten further generations. You see what I mean? The power just keeps going when you really dive into it.
I see. Yeah, I absolutely see. So, okay. So, in terms of people watching this now, we can only scratch the surface. Let's be honest in the scope of this call. So, can you paint a picture of the people that you can typically help? Who would you be? You know, if people are listening to this and thinking, well, I don't know if this is me or not.
Yeah, that's a really good question, and let me try and narrow that down because it would help rather than give false hope to people that they can tap into all of their pensions when they can't. I would say first and foremost, just be good at what you do. You've already done 2 or 3 things. You know, you've done it. You know, this is your calling. Now that's in your heart. That's not something I can judge. Secondly, you have a limited company that's established and it's doing something. It's not you set it up yesterday. There's no time limit here, but let's say, it's been running for a period of time where there's some evidence of money in and money out, ideally. You have either on your own or in combination with others, £100,000 worth of old pensions, or old pensions and new contributions could equal that. Or you've got £50,000 now, but you've got some profits in your company. You can get to about 100,000 within a year, I would say. And you've got some ambition left, so you still want to grow. You still want to see the pension money do something positive in your life. And it doesn't matter how old you are, by the way. It doesn't matter how young you are or how old you are. If you've got those credentials, then we can probably help you. And if you haven't, I meet a lot of people who might have smaller pots and they don't have anybody else to collaborate with, then just keep building the pension pot up. If it's with an employer, if it's in a private scheme, just maybe have a conversation with us separately, because I remember I said to you I was an IFA that turned into an AFA, an alternative financial advisor. I still have the IFA practice, which means we will help anybody who ultimately wants to be a future SaaS owner, just reduce the costs of running their pension so that they see the benefit of taking some control, at least the control of costs. So that's one of the things I would suggest anybody does. So most people can get to a SaaS within, even if they're starting property, within a couple of years, but many are already there right now. And they should be able to see themselves in that story and say, yeah, I've got a limited company. I know what I'm doing. I've got some money. I'd like to use that money. They're probably a good candidate for a conversation, which will take a month or two just to make sure they've embedded the knowledge to say, yeah, that's for me, or actually, no, that's not for me, and that's fine.
Okay, brilliant. So let's talk about how people can make contact, because I know we're going to have a lot of people who are saying, yeah, that's me. I tick that box, or that's going to be me soon. The call to action here, what's the best way of anyone making contact with you or the team to move things forward and have that conversation, even if it's that, you know what, we can't help you now, but further down the line, we're definitely going to be able to. How should somebody reach out?
Well, the website is wealthbuilders.co.uk, but I think it would be helpful for us to create a special goodie bag of knowledge and benefits that we can link directly to you, Ant. So we can create a unique bit of information that would be helpful, and then we can see that people are getting the right amount of combination of something to read, something to listen, something to watch, so that however people want to take in information in a world that we mentioned at the beginning is multimedia. Not everybody reads magazines as fully as they used to. Not everybody can listens to podcasts. Not everybody likes to watch videos for all sorts of reasons. Why don't we put something together for them that is read, watch, or listen? You'll get enough information to at least decide whether you want a first call and have an exploratory call with us, which would be free for up to an hour.
Okay, fantastic. Well, I can definitely make sure that we put a space on our website to direct people to, if that's the easiest way of achieving that. So why don't we give a website address now that will be yourpropertynetwork.co.uk/wealth, yourpropertynetwork.co.uk/wealth. We'll make sure that we've got the link wherever you're seeing this, or wherever you're viewing it, wherever you're listening to it. We'll make sure that link is clickable so you can navigate directly there. And we'll make sure that there's some more resources there as well from Kevin and his team. This has been a whistle-stop tour of SaaS pensions and what they can be used for. I know we're going to do more of these and showcase some examples as well of some of the amazing things that people have achieved that maybe they didn't think they could have done. Maybe they thought was just out of their remit. So
yeah, that's a really great point. In the same way as, my hat's off to you and your great team at YPN for the case studies, which are always fascinating and inspire people to see things that they didn't see for themselves. We've got hundreds of case studies of people who just run out of something, and then they got not just the imagination from somebody else's case study, but then they got the money to deliver a case study for themselves. So that will be a great thing to share in future episodes, for sure.
Fantastic. Well, look, Kevin, massive thanks to you for your time and expertise today. YPN is all about ordinary people achieving extraordinary things in property. I think I may have used that line 10,000 times over the last 16 years, but it's always remained true. Everybody we speak to is just an ordinary Joe, ordinary person who has made a decision to do something and betted on themselves and mitigated the risks and taken the action to do so. And so I think it would be, we definitely couldn't do what we do without the input and expertise of people like yourself sharing what is possible. So a massive thanks from me and anybody reading, watching, or listening to this.
Thank you very much for the invitation. It was a pleasure.